spreads are a bit tighter than where they are on average. Underwriting standards are a little bit looser than where they are on average. And that may mean there's a reset needed, but that is not also synonymous with like a bubble.
And we are live, episode 12. My name is Josh Flade. I'm your co-host with Paisley, Nardini of the Building Better Portfolios. And we have Andrew Beckman here. He's with Future Standard. He's the head of global credit. And we're super excited to be talking with you, Andrew, about credit. Specifically, we'll be focused on private credit. But before we dive in, why don't you tell us a little bit about your career?
Yeah, sure. Well, thank you for having me today. Fortunately or unfortunately, it's been a long career for me. I've been in finance for almost 30 years. Interestingly, I've worked in a few different areas. I started out in investment banking and mergers and acquisitions, and then I spent about 6 years in private equity, working at a firm called InvestCorp. I transitioned over to credit in the early 2000s by joining Goldman Sachs' special situations group. And ever since then, I've been focused on credit, distressed credit initially, and then transitioned into private credit. So I've got a lot of different kind of flavors, of kind of investing in my career, and it's been a fun one.
That's awesome. I'm sure the Goldman experience was quite the learning experience. We have a similar alma mater then because I went to Goldman as well in their credit research group. Fantastic place to learn. Well, let's follow up with another question, which is just that we ask each of our guests. Tell us something about yourself that most people don't know.
Oddly, I'm quite handy, and my wife always kind of jokes about it. How does someone with like a nerdy desk job, be good at like building things and fixing things, when most of her friends' husbands like don't know how to use a screwdriver. So she jokes with me a lot about that. But on the weekends, I'm often like taking on projects around the house.
Really could have used you on Sunday, Andrew. We had a bathroom faucet issue that resulted in calling a handyman and $400 later. So had I known, I could have called you.
I didn't say I like it. It's just an interesting fact. I can do it.
Yeah, that's impressive.
It's a good skill set to have. I replaced a couple of faucets this last weekend, and yes, it can be painful. I don't love it either. Well, I would love to dive into just the meat of this conversation. Obviously, given your position in special situations, your position or history in special situations, but then also what you're doing at Future Standard. Love to dive into the private credit landscape and just hear from you kind of like, what is private credit? If you had to explain this to somebody who's new to the industry, I'd be interested to hear how you would explain it, because I know it just, for those in the industry, it's been a very popular asset class. It's been in the headlines a lot lately, but it's seen a lot of growth over the last few years as far as assets under management. So how would you explain that to somebody?
Yeah. And I'll start off by describing generically what private credit is, but I think it's important to unpack the various different areas of private credit, because over the years it's really kind of become somewhat kind of multifaceted. The simplest way to describe private credit is it's when an investor, so someone kind of managing funds, essentially, lends money to a company, or an entity on a bilateral basis. And, the negotiations and the transaction is direct from that investor to the company. It differs, from, other forms of credit, like most notably in the corporate space, broadly syndicated loans or high yield, in that in those asset classes, what you have is an intermediary that's usually sourcing, structuring the transaction and then syndicating the transaction to kind of investors who are removed from the negotiations with the company and the structuring and whatnot. So that's really what it is. It is a private bilateral loan from a person with money directly to a company or entity that needs money. What I would say, to go a step further, is that's just generically what private credit is. But really, over the years, private credit has kind of become multifaceted. There's lots of different, silos like within private credit. There is, traditional, direct lending, where these private investors, that are managing funds, are lending to kind of sponsors, right? Leverage buyout firms that are buying companies, right? And that's probably the largest part of the private credit market when these big financial sponsors are looking to do an LBO. They used to turn to kind of banks, to provide, broadly syndicated loans or kind of high yield bonds or a combination thereof. And now, as an alternative, they can potentially go and get a loan directly from a private credit firm. That is, probably where the industry started, but it's evolved, right? It's evolved into, loans to private equity firms to do other things, to kind of do recaps, to do, kind of M&A, bolt-on acquisitions. It's evolved into loans to non-sponsor businesses, private companies owned by, families, kind of entrepreneurs. It's evolved into kind of asset-backed lending, so private loans against pools of assets, not just to companies. And then, there's also, a part of the market, that a lot of people, use the word capital structure solutions to describe, which I like to say is sort of like creative lending. So lending into kind of more funky, special situations.
I have a quick question. I think in the industry at large, there's a lot of discussion on the boom of private credit in the post GFC era, just given bank regulations. And so ultimately we were turning to these, non-large bank institutions to help fund projects and businesses and such. But it feels like private credit has really taken off, though, in the last 5 or so years. What's been that recent catalyst? Like, why is private credit everywhere we look? And I'll even kind of half jokingly, a lot of advisors say every time I open my inbox, there's another email from another private credit shop. So, like, what do you think is the driver behind this recent surge in activity?
Yeah. So I think it's been a bit of like a virtuous circle, right? Where it starts is like the value add for the borrower and the demand for that capital, right? Um, yeah, yes, following the GFC, there's been a bunch more kind of like red tape that banks have to deal with, both on the types of assets that they can hold on their balance sheet, as well as kind of capital requirements. Before the financial crisis, banks were not that easy to deal with. And post the financial crisis, they're even harder to deal with, right? So when you go to get a private credit loan from an investor, that end use investor, dealing with that investor is a lot easier than dealing with the bank. You're talking to the investor. Those investors can make decisions much quicker than banks. They're not subject to kind of like regulations or different constraints on what the loan could look like. You want the loan to look a little more like this, a little more like that. These private credit firms can flex when banks may not necessarily be able to flex because of kind of certain lending like requirements. They can go through their approval process a lot quicker. There's fewer people that kind of need to like approve these deals. And there's certainty because when you're dealing with a private credit firm that's actually writing the check, like if they want to write the check, they just write the check. Remember, the bank is just a middleman. They are basically telling, if it's a private equity firm, we think we could syndicate a deal that looks like XYZ. And then if that private equity firm wants to move forward with that bank and go through the process, they have to wait till that bank runs the syndication process to see the outcome. So there's more certainty, right? So it's a lot easier to deal with these organizations. So that's why there's demand. There's also no middleman from a fee perspective, right? Like banks charge syndication fees. So by removing the syndication fee, what private credit firms are able to do is charge a little bit more. like have a little bit more spread in their deal. And they could have a deal that's, maybe 100 basis points kind of wider than what a broadly syndicated loan might cost. And the end cost to the company could be the same by removing the syndication fees, removing all the other costs kind of like, involved in the transaction. So that's sort of where the virtuous cycle starts, right? It's like, okay, there's the demand for this loan because of the simplicity. The private credit firm can charge a little bit more where the borrower is indifferent. And now that investor can take loans like that and market to investors and say, why would you invest in broadly syndicated loans? You can invest in my loans and get an extra 100 basis points of spread, 150 basis points of spread, and take similar risk. So now then the investors start pouring money into that asset class because of that excess spread and similar risk profile. And now the private credit firms have more money to offer and they can do bigger deals, and the private equity firms are calling them more often. So that's really kind of what's been going on. You've seen private credit take share from the public credit market, and money continue to kind of come in because of kind of the better returns and risk reward profile.
So with the growth of private credit, and I know Jamie Dimon's been in the news over the last few months. Gunlock was in the news in the last week talking about private credit and throwing around terms like bubble, cockroaches. If there's one cockroach, and that's in reference to some defaults that we've seen recently, there's probably more cockroaches. I mean, what do you think? Is this a bubble? Is there some potential systemic issues facing private credit from your perspective?
Yeah, I'll answer that in two parts. It's like a really good question. I think Jamie Dimon's comments were a little bit kind of like off mark. The situation that he was referring to originally was First Brands, which is an auto parts aftermarket distributor and supplier, and that was actually like a broadly syndicated loan, and that went bad. Um, what's interesting there is it actually shows the weakness of the broadly syndicated market. And there was a CEO of a very large private credit firm that came out afterwards. I won't mention his name, but he basically said to Jamie Dimon, he's like, "Don't talk about what's going on in our market. Talk about what's going on in your market, because the very reason we like investing in private credit is something like this wouldn't happen in our market." Right? So what happens in the broadly syndicated market is investors aren't allowed to do real primary due diligence, right? Investors have to look at something that's presented to them, by a bank or intermediary, and make an investment based on that publicly like available information. That's third party information, whether it's audited financials, research, like a deck that's kind of been put together kind of by the company or the person syndicating it. And you have to base your information on that. Now, where you could run into problems in the broadly syndicated market is where that information paints an inaccurate picture of like the financial profile, or, the business situation of the company. And that's really what happened with First Brands. I mean, their financials did not really tell a true story of what was going on at the company. And, it may come out that the financials, are fraudulent, but public investors don't really have a way to kind of check that. Now, if you were in the private market, like if you were doing a private transaction with First Brands, they would send you the audited financials and a company presentation and all the same stuff that Jeffrey sent out, to the investors of First Brands and the various syndicated deals it did. And you as a private credit investor would say, "Oh, that's great. I got to verify this in diligence. And how do I verify this in diligence? I'm sending a team of accountants, down to your office to kind of go through your books and records and piece together their own financials to make sure the audit's correct. Like, by the way, my lawyers are going to look at all financing relationships, whether they're on balance sheet or off balance sheet, send them all the corporate docs, the legal entities, the legal structure, how this works. We're going to do lien checks and all this stuff. All the stuff First Brands was doing, which was essentially likely cooking their books combined with not disclosing a bunch of financial arrangements, would have been picked up in private credit. The bubble I worry about is the broadly syndicated market, where underwriting's gotten very loose and investors have been given less and less information every year that they can use to kind of evaluate things. And I think it's a great example of like why private credit's an interesting asset class. We believe private credit offers excess spread, but we also think at the end of the day, you will see less losses in private credit, whether it's kind of fewer defaults or similar defaults but higher recoveries. We think the loss adjusted returns are going to be higher than just the differences in spread.
Two questions on there. The first is a comment you made on the underwriting standards, and just kind of noting that within the credit cycle, broadly speaking, it's right after the fraudulence or like the credit events, the recessions, that those standards really tighten up. And then as we move through the cycle, they tend to lessen or loosen. Where do you think that puts us then in the credit cycle if we're starting to see some of the syndication standards kind of a little bit more relaxed than maybe they should be?
I think we were getting later cycle, like in terms of some of the standards that were applied for sure. I think something like First Brands, probably creates like a little bit of like a reset, in terms of underwriting standards, information, that investors kind of demand. So there's something probably a little bit healthy about that. Um, I think though, like when people think about like being kind of late cycle, there's a difference between being late cycle and being like in a bubble, right? Late cycle is, spreads are a bit tighter than where they are on average. Underwriting standards are a little bit looser than where they are on average. And that may mean there's a reset needed, but that is not also synonymous with like a bubble. A
Yeah.
bubble is when you have like unsustainable valuations, unsustainable kind of capital structures, right? Things that are getting done that really just don't make any sense. And I don't see that in the market right now. We're not underwriting to kind of EBITDA, that doesn't exist. There's not like leverage levels that are like way out of check. There's not, deals being done where the cash flow doesn't support the transactions.
And then maybe the second part of my question was around default rates. And I think many investors may make the assumption that to move from, public high yield corporate bonds into private credit, you're taking on a lot more risk because there's higher default rates. But I think, at least historically, what I've seen is there's maybe not that much of a difference between default rates on those two markets. So what is your research, or what do you see on a default rate perspective?
Yeah, we have not seen a much of a difference between the public and private markets on a default basis. Where we have seen a difference is on recoveries, and we tend to see recoveries that are much higher in the private markets. The private markets have better covenants. A default usually happens much earlier, in the game when things can kind of be righted. In the public markets, defaults usually happen very kind of late in the game once there's been so much credit deterioration that the equity's kind of out of the money, and then the creditors get the keys, and it's usually not a good situation.
Yeah, really interesting too. And just thinking about where spreads are in the public high yield space, obviously quite tight. A lot of that too just has to deal with issuance. And then to your point, is this availability of private credit, investors flocking to private credit. A lot of these high yield companies just haven't been issuing either. So some of the supply demand is interesting as well.
Yeah. Yeah, I think that's certainly one thing that drove spreads tighter, right? Was the supply demand being out of whack, M&A sort of being shut down, and money continuing to kind of flow into private credit. So spreads definitely got tighter. I would say though defaults are starting to go the other way. Like certainly if you look at like the public market as an example, defaults have ticked down this year. And I think what you're seeing is kind of interest rates help things, right? Like, I mean, almost all deals out there are kind of floating rate, and we entered 20. I mean, 2023 we averaged like 5.5%, kind of SOFR, and that's kind of ticking down. We're now at 4%. The forward curve says kind of by the end of kind of next year we're going to be closer to 3%. I mean that makes cash flows kind of healthier, so it offsets some of the other factors.
Yeah, there's almost this counter cyclical effect of if interest rates come down really quickly, it actually helps these companies with their cash flow because they're paying less money in interest.
Right.
The so tied to this kind of conversation around bubble, I know I've received a few questions this last week around AI spend, concerns that, hey, are we in a cycle similar to what was seen during kind of the internet boom, where suddenly you're getting tons of fiber being laid all across this country, and then a lot of that fiber never even got turned on, kind of this term dark fiber, and so there's this overspend. And I know that there's concerns around AI, and is there going to be an overspend on AI data centers, and who's funding this, and is private credit funding a bunch of these, and are those data centers just going to sit there and not get turned on, and there's going to be credit consequences for private credit funds? What are you seeing from that perspective as a private credit investor?
So yeah, we're seeing a lot of activity around AI in private credit. And the types of things that you're seeing is, financing of kind of data centers, financing of like GPUs and servers that go, kind of into kind of data centers. And then also, financing of like AI companies, whether it's kind of like the CoreWeaves of the world, the Crusoes of the world, other. So there's lots of different kind of flavors of kind of, financing within, the AI world. Look, I'm not a tech guy, like hard to tell kind of what ultimately kind of happens. I would say that, we see good ways to kind of make sound investments in the AI space. And then we see things that do look a little like more speculative. Um, we have been focused on, providing, financing into the space when there's contracted cash flow with high quality counterparties, maybe even IG counterparties, right? So, like, we've done some stuff where we've financed a data center or financed a chip where the data center has, basically like an IG tenant, and that IG tenant signed a lease that goes well beyond the term of our loan, and that lease creates like enough cash flow to essentially service and amortize our loan. We've done something similar in the space where we've financed GPUs, and servers that are placed in data centers that are leased to IG counterparties, and you could look at the term of the lease and the cash flow generated by the lease and get comfortable that those specific leases will cover our cash flow. So I think other firms are doing things like that, and that, to me, that doesn't seem that speculative if you've kind of done your work and you're sort of financing cash flows. Now, whether companies like Microsoft are signing up to capacity that they ultimately don't need, and it proves out to be a bad ROI for them, that's probably something that affects like equity holders in these businesses. Um, some of the more speculative stuff in the space where you're providing a loan to like a cash flow negative like AI company, like the company itself, and it's not asset backed, that's probably a little bit more speculative. But like, I don't think it's widespread. I think most of the private debt capital that's going in is going against contracted cash flow.
Across that private credit landscape that you described in our first question, where are you seeing areas or pockets that look more attractive than other areas?
So, like, we're a little bit more focused on being kind of off the run, to try to focus on areas where a lot of that capital that's been flooding into the industry isn't going, right? So if you start off by saying, where is that capital going, right? The most prominent part of the market right now, where capital is flowing, is to large cap direct lending funds, that are focused on blue chip private equity firms and financing businesses that they're buying. And, you know, it's sort of like this thing where for the big firms, they focus on areas where they could deploy lots of capital, right? Like they can employ, 500 million, $1 billion, $3 billion of capital per transaction. And then they could turn around and raise lots of capital to kind of fill that. It's really good for their business models. I'm not saying it's necessarily great for investors, but it's good for their business model. Focus up market where you could deploy lots of capital and then go raise kind of like lots of capital. Because that's where the bigger firms are sort of focusing, they've sort of focused less like down market in areas where like the tickets are smaller, right? And that's sort of where we find things to be like a little bit more interesting. So sponsor based lending, but lending to kind of smaller sponsors that, are looking for, 100, 200, $250 million of capital, for their transaction. The big guys don't focus on that anymore. And that's where all the positive flows are. And that means there's less competition, and it means you can, demand higher spread, maybe lower LTV, and like better docs. So we find smaller sponsor lending more interesting than large cap sponsor lending. The same theme, but it's kind of supercharged, exists in non-sponsor lending, right? So lending to companies that are owned by family offices, kind of entrepreneurs, strategic investors. The return on time there is not great. It's harder to put out large chunks of capital, so it's the same dynamic. Those businesses often tend to be a little bit less, kind of savvy in terms of like who to call and where to find capital. So it's a little bit more dislocated there in terms of the market, and you can get better terms there, right? So like we look at like large cap sponsor lending, and then you go to small cap sponsor lending, and we're like, okay, there's probably like a 50 basis point premium there, maybe 75 basis point premium, but it's lower loan to value. It is lower leverage. It is better docs. So loss adjusted returns are probably even better than that 50 to 75. Non-sponsor lending, probably adds another 100 to 125 basis points with the same thesis. You're chipping down on kind of chipping away at LTV, getting kind of like better docs. So we really like those two areas. And then, the other area that we like is the cap structure kind of solutions area. And what you're really kind of preying on there is a part of the market that doesn't have like a natural financing provider. So, a company, like a situation, that has some level of complexity to it. And that complexity on its own, it scares away the commercial banks, the regional banks, the insurance companies, as well as the typical direct lenders who are looking for kind of rinse and repeat transactions. And then you can see, hey, maybe there's a way to make a safe loan to a complicated situation. So the complexity maybe adds a little bit of risk, but is there a safe way to lend to that business, right? Maybe there's a business that's like sort of stressed from an operational standpoint, but, they've got a whole bunch of assets that you can lend to at 30% loan to value, right? The fact that there's a little stress going on at that business scares away all these investors. And at the end of the day, you're like, yeah, but I can lend 30% loan to value against real estate, AR, and inventory, at this entity, and make twice the spread that you could make in direct lending.
So maybe a quick question I would have is from the lens of the investor and thinking about like the overall objectives and why they would invest in private credit. I think first and foremost, diversification from public credit, higher yields. So there's obviously a lot of dispersion based on, what markets that you're lending in and the terms of a lot of these deals, but broad brush stroke, like what types of yields, what types of duration, what types of exposure is FS focused on?
So it's a good question. We're really kind of focused on those three areas that I mentioned because we view them as the most attractive part of the market, right? The lending to smaller sponsors, non-sponsor lending, and cap structure solutions. So we find those areas really interesting from a risk adjusted return perspective. And I think where you're sort of going is like, well, which of those areas should appeal to kind of like who, and
Or more
like
like
what do they,
what, yeah, like what level of yield are investors expecting, 8%, 14%, and then like from a like broad kind of duration perspective, like what's the duration of a lot of these loan profiles?
Yeah, so like I like to think of things on a spread basis
Okay.
because rates are jumping around, right?
Hmm.
And some people are anchored to 24 rates and some people are looking forward to 26 rates. So then if you look at total yield, we're talking apples and oranges. But
Yeah.
like here's the way I see the landscape. Broadly syndicated loans, like you want to invest in a levered loan kind of ETF or, like a fund that invests in kind of broadly syndicated loans, like a fairly high quality, broadly syndicated loan, like a B3. So these are like LBO type loans these days probably comes with a spread of around 350 basis points, like over SOFR. If you drop down into the private credit market and you're looking at very large cap private credit, right? So, financing buyouts for the Blackstones and KKRs of the world, what the really big guys are doing, that probably comes at like 450 to 475 spreads. So, call it 100 to 125 basis points spread premium to the public market. And then you start entering the areas that we talked about, which is, smaller, more middle market sponsors, high quality sponsors with good track records, but smaller that companies that don't have like the same access. You're probably looking at another 50 to 75 basis points of spread versus that large cap part of the market. So that's call it, 500 to kind of 525 of spread. Drop down to kind of non-sponsor, you're probably adding another, 125 basis points to 150 basis points of spread. So you're at, kind of 625 to kind of 650 over. And then when you get into kind of capital structure solutions, that's the one area where it probably does become more of like a yield play, because that competes a little bit more with equity. That stuff for us is call it, 13, 14% plus.
Got it.
So depending on where you're looking, like the areas I'm talking about, you're looking at, you know, you know, 200 basis points, 300 basis point premiums to kind of public credit, and then, in the cap structure solution space, you're looking at really kind of alternatives to equity type products.
Andrew, if we could take 1 minute to talk about the pricing of loans in the private markets, because I think that's one of the biggest concerns is that it seems like sometimes, a loan will be priced at par, close to par, and then suddenly it defaults and now it's marked as zero or something along those lines. I mean, what's been your experience? Do you think that there's a systemic problem with pricing of loans in private credit?
A really good question. And I'm not sure I would say there's a systemic problem, but I do think one of the issues in the market is every manager tends to kind of deal with this a little bit differently. And I think the problems are a lot less prevalent with high quality managers. Um, I think most high quality managers, use third party valuation firms to do, valuations on a quarterly basis that should take into account, what's happened with the specific credit, what's happened with the market, what's happened with spreads. And if there's truly like a third party process that's going on, um, marks should be somewhat appropriate, right? They should follow kind of like the public market. You've also seen some of these high quality managers that kind of have moved more kind of into retail. Some of them have migrated to monthly third party marks. Some have even migrated to daily third party marks. We have some products. You've got a private credit interval fund in the market, and kind of the platforms that it's on demand basically marks on a daily basis that looks at kind of like spreads and interest rate moves and whatnot. So I think the industry is kind of getting better as it gets kind of like more sophisticated in terms of marking, much more accurately. But there's definitely the bad actors out there, and some of like the truly private funds like have very you know, they've got policies that you could kind of drive a truck through, right? Like, I mean, if it's really like a private fund, they've raised a drawdown fund to do private credit, or it's a private like evergreen fund. I mean, the fund docs may say that they can internally mark, the instruments, right? And they don't have to, update every mark every quarter. All they have to do is a third of their book or a quarter of the book. So, yeah, firms like that, they're probably not marking their portfolios, appropriately. And, if something kind of bad gets out there, it's sort of like one of those actors kind of creating headline risk, for kind of good actors where that risk doesn't really exist.
That's a yeah, great answer. We want to ask. This is a new question we're testing out. I'd love to hear your experience or your story of the worst investment you've made, and what was like the biggest lesson you learned from that you still carry as an investor going forward.
Yeah, I mean, I don't know if there's been one, but there's definitely been, like a handful of kind of bad investments in my career. I mean, it's kind of hard to not have something like that. And I sort of look at like, the common theme, and it's really you can't invest in a bad business, right? That's really what it comes down to. Sometimes I think, people, and I've made this mistake in my past, think you're smart enough to kind of figure out the right amount of money that you could advance to a bad business, or that you can advance money to a bad business and get out in time, before kind of the business falls off a cliff too much. And what I've come to learn, in a handful of situations I've been involved, is like, bad businesses often deteriorate quicker than you would expect, and often have outcomes that are kind of worse than you expect. So just stay away from bad businesses, like, declining businesses.
I joke with friends of mine in the industry, common sense is uncommon. And I feel like that's a good common sense answer, right? And
Yeah.
there's so much truth in that.
So maybe in the interest of time, we'll wrap up. And another question we like to ask all of our guests is if there's anyone who has made a very impactful impression on your career, helped provide guidance, helped kind of your success and where you are today. If you have a shout out for them, we'd love to hear the story.
Yeah, I don't think I'll give a shout out to one person, but I think what I would say is I've worked at a few different influential places, and they've all like kind of added like a different arrow, in my quiver that I think have made me the person I am. Like being in private equity for a large part of time, like it forced you to just get super, super deep, right? The average credit investor, like they're not used to getting as deep as kind of private equity. And private equity sort of teaches you that you really got to uncover like as many stones as possible to like avoid mistakes. So my time at InvestCorp, really kind of gave me that. I think a lot of kind of the commercialness that I got in my career came from kind of Goldman Sachs and the people I worked with in the special situations group there. I worked with a lot of great people, like, over the years. And It was probably the sharpest group of people that I've ever kind of like encountered, right? In terms of just like commercialness and like investment acumen, seeing opportunities, going for them, staying away from things, that didn't make sense. And then, the last thing I'd say is I worked at a firm called Magnetar for 4 years, for a guy named Alec Lidowitz and a guy named kind of David Snyderman. And, that firm was, one of the best firms, I've ever seen in terms of thinking about like risk management and really taking an investment and breaking it apart to kind of understand the components of the return and the components of the risk that you were taking. So, like, while I feel like a firm like Goldman, the commercial judgment and instincts, you know, um, and just sort of like investment acumen really excelled. At Magnetar, they were really, really smart about breaking down risk. Like, you're making a loan to the business. Like, how much of this is just pure market risk and cycle risk? And, you're just writing a put on the economy, versus actually charging, like a spread for the business. So I think that you put all those things together, and I think that's kind of, what's made me successful. And, all three of those kind of organizations, were instrumental in that.
Well, I appreciate you sharing that. And I would say, kind of encapsulating our conversation here today, hopefully our listeners feel the same, but I'm more optimistic, not that I was pessimistic, but more optimistic on private credit, where we are in kind of the credit cycle broadly. So I really appreciate your time today, Andrew, and sharing all these insights.
Yeah, well, thank you for having me. It's been a pleasure.
Yeah, thank you, Andrew.
The views and opinions expressed on this podcast are those of the host and do not reflect the views, opinions, or policies of any current or former employer, affiliated firm, or client. The content is provided for informational and entertainment purposes only and should not be considered investment, legal, or tax advice. Nothing discussed constitutes a recommendation to buy or sell any securities or investment products. Listeners should conduct their own research or consult with a qualified professional before making any financial decisions. The hosts are speaking solely in their personal capacities, and the podcast is not affiliated with, sponsored by, or endorsed by any firm or organization with which they may be associated.